everyone, welcome back to the channel, your number one source for income-oriented investing. So as we know, the covered call income space continues to expand and to explode on the US stock market, a lot more options. But one provider that's been growing very, very rapidly in terms of AUM is NEOS. They continue to grow their lineup. They continue to grow their funds significantly. So I'm happy to say that they are sponsoring today's video. So what I'll do is just do a quick follow-up, a quick catch-up on some of these funds here, and then we're going to talk to Troy Cates, co-founder and managing partner at NEOS, and really ask him all kinds of questions about their ETFs, their recent launches, what we could expect in the future. We'll do even a little bit of deep dive in their covered call strategy, because that is the most important thing for us to understand as income investors. So their very first one, I'm really going to focus on their equity ETFs here. So they have SPYI, which focuses on the S&P 500, QQQI, which is a little bit more recent, focuses on the NASDAQ 100, and pretty new is they also have IWMI, which focuses on the Russell 2000 index, which covers the small cap space in the US. They also have an aggregate bond one and a cash alternative one as well, if you're interested in lower volatility, lower risk options as well. But I'm really going to focus on the three equity ones. So what I noticed right off the bat, first of all, with SPYI, their biggest one by far in terms of AUM, check out this AUM, everyone. We're talking over $1.8 billion of AUM. This is very, very big. So obviously very, very popular S&P 500 covered call ETF. And all of them, by the way, all three equity ones, the management fee is 68 basis points. That is the MER. So what I really noticed about these over time is the extremely consistent monthly distributions. So they're typically very, very consistent over time from month to month. Recently, the latest one has been a lot higher, 55 basis points. We're going to ask Troy why, but obviously we know that it has to do with volatility going up recently. But you could go throughout the years here. You could go to 2022, 2023. It's been a really, really nice, consistent monthly distribution with an approximate yield of about 12%. So right now, based on the last, let me see here, this 12.34. This is based on the last distribution, but I would say it's a fairly consistent, approximately 12% yield or 1% a month. So very interesting ETF if you're an income investor, obviously, but you're living off of these and you want a consistent source of monthly income. You want to invest in the S&P 500 or the NASDAQ. So of course the NASDAQ more volatile, and the Russell 2000 as well, more volatile than the S&P 500. So you see the yields are in the 14% here. So very, very nice high yields, but still consistent monthly distributions. The latest ones have been a little bit higher. You could see here 65 cents versus 60 cents for the Russell, and then the month before was 54. NASDAQ 100, same thing, right? They've been going up. So this is all good sign. If you're an income investor, you want to invest in equities, but you want a consistent monthly income. So I would say these fit my criteria, my personal opinion, of course, where they're ideal to live off of. They're great because the level of income is fairly high and the distributions are fairly consistent, and you're actually capturing some of the upside of the corresponding index, whether it's the S&P 500 or the NASDAQ 100 or the Russell 2000, et cetera, et cetera. So obviously it's a covered call strategy, so you got to give up some upside, but you are capturing some of that upside, which is why even the stock prices have been relatively stable for these funds, in addition to getting that consistent monthly income. So enough of me talking now. Let's talk to Troy. Let's figure out how they're able to have these really sustainable and consistent monthly distributions. We'll talk about the covered call strategy in detail, the portfolio coverage, how much, on what percentages of the portfolio are they writing covered calls on? What are the typical average moneyness of the options? Is it 1% out of the money, 2% out of the money, and really do a deep dive on that. So let's get to it. Let's talk to Troy. All right, everyone, I'm here with Troy Cates. Troy, thanks so much for coming back on the channel. It's been a while. You are the co-founder and managing partner at NEOS. How's it going? How you been?
Things have been going great. Thanks for having me back. I'm looking forward to our discussion today.
Pleasure. Yeah, we've had you on the channel before, talked about, SPYI when it first came out, but it's been a while since then, and your funds have gone very popular. They've been growing in AUM. So I got a bunch of questions for you because, these are some of the community favorites. So let me just start by asking you, the professional who lives and breathes this stuff every day, covered call index-based ETFs, like the S&P 500, Nasdaq, etc. They've literally exploded on the U.S. stock market in the last 2 years, right? You guys got a lot of competition now. So my first question right off the bat, what makes your ETFs, your five ETFs, really stand out versus all this new competition you guys are getting now?
Sure. No, it's a great question. I think what we focus on is the options portion of the portfolios. We are options managers at heart. We do all of our portfolio management and trading in-house here.
Mhm.
NEOS stands for Next Evolution Option Strategies. So it's what we focus on. It's what most of this team has been doing for decades. And we were some of the early pioneers in the option-based ETF space, launching funds over a decade ago in this space when there was only a few option-based ETFs that actually paid monthly income at the time. So fast forward, like you're saying, you look at the past 2, 3 years and this tremendous growth in the option-based ETF space. Now, I think last time I looked, there was over 430 different option-based ETFs that are paying some sort of monthly distribution or some sort of buffered strategy. So the space has grown a lot. And something we always tell clients is when you're thinking about getting into this space, know what your goal is. Are you looking for income? Are you looking for a total return? Are you looking for tax efficient income, which is something we focus on? And really dig into the option strategy and what each fund is doing. There's so many resources out there, whether it's working with you or others, to really understand what is in these option-based portfolios, because not all option strategies are created equally.
Yeah, yeah, for sure. I'm always trying to find the differences between them. The index might be the same, but it's really the option strategy that's different. So one thing I noticed, because I live and breathe this stuff, I gotta know all the competition, know all the ETFs, understand them, and know the different strategies. Really the thing that stands out with the NEOS ones, and I'm really focusing on more your index space, so the SPYI, the Nasdaq one, the Russell one. Those are your three, equity ones
Yep.
that I really want to focus on this Q&A. We'll talk about the other ones a little bit as well, but I noticed that your distributions, your monthly distributions are extremely consistent. That's actually very rare for this type of product because as we know, option premiums, cover call premiums, they can vary greatly based on net asset value, volatility in the market conditions. So how are you guys able to deliver? And this goes for all three of them, right?
Mhm.
SPYI, obviously, we have the most data. It's been out for over a year, but I've noticed even the newer NASDAQ and Russell 2000, they already seem to have very consistent monthly distribution. How do you do it? What's the secret?
No, it's a great question. And I think a lot of people look at it and say, is the income coming straight from where volatility is? And we've seen volatility spike over the past few weeks as we saw the sell-off earlier in August and then the rebound.
Yeah,
So for us, we're always using rules-based strategy. So our option model is really a systematic rules-based model that we're following on a monthly basis. So we're not taking discretion in a sense of whether it's myself or one of the other portfolio managers
mhm,
coming in and saying, oh, I had a feeling about this. We're following this rules-based model. And one of the things this model does is not only is it looking at volatility and the rate of change of volatility and how that works in certain levels of, call it out of the moneyness and different deltas of what these short calls are doing and bringing in premium into the portfolio, but it's also looking at how much notional of the portfolio it should cover. So to give you an example, on average, we'll use SPYI as an example.
yeah,
SPYI might be anywhere from 75% to 90% covered on the notional of the portfolio. So given on the higher end, 90% covered on the notional, there's still a good 10% of the portfolio that's not covered by those short calls. But when volatility moves higher, not only are you able to write calls a little further out of the money, but you
yeah,
might also be able to write on less notional of the portfolio. So you're still bringing in that income to have that consistent, steady distribution on a monthly basis. And for SPYI, the kind of range that we're looking at is that 10 to 12% range is where we'd like to sit on an annualized basis. So call it, just around 1% a month. But
yeah,
again, we did see a spike in volatility earlier in August. And when we made our distributions this month, it was a little higher. But also, we were able to cover less of the portfolio. So on the lower end of that range we were discussing and right further out of the money. So we were able to bring in enough income. So there's a number of different levers that the model will use as it's looking at where it's going to actually sell those calls, how much of the notional it's going to cover, and so forth to bring in that premium to keep it consistent.
yeah. Super interesting. No, I love talking about the option strategies. I could talk about this with you all day. And my next couple of questions, and you already, touched a little bit on this. I want to really dig deep on the option strategies because that's what really makes a difference between these different products. So, you guys have a unique strategy where I believe you You sell index call options. So, whether it's on the S&P, the Nasdaq, SPS, NDX options at one strike price, but then you buy another call at a higher price. It's typically called a spread. So, is this still the case? Is this part of your rules-based strategy, or is this going to be like this is the strategy, but depending on the conditions, the prices or the strike prices might be different. So, first of all, is that still your strategy? Your
So yeah, no, it's a great question and it comes up a lot. So basically, you're describing a call spread
call
versus just
spreads?
the
Yeah, that's
laddered
it.
short calls. And the portfolio, the rules-based strategy has the ability to switch from the laddered short calls where it's selling, say, two different calls out of the money on a monthly basis, or the next month when we're rolling, depending on where volatility is and
Okay.
certain other levels, it might change to a call spread where we're selling a call and then buying one further out. Now, the
Okay.
volatility levels of these funds, of all three, including SPYI, which is just coming up on its 2-year anniversary, has not hit those levels where we would have switched into a call spread. So since inception, SPYI has just been in a covered call strategy where it's selling these laddered calls out of the money, rolling on a monthly basis. But we have not seen, we came close, I think, when you start to see the VIX really move lower into that, 11, 12 area. It came
Hmm.
close, but the model didn't have it kick into that call spread. And the idea with that is if we're at a lower volatility regime where we're bringing in less income, if I'm writing out of the money, we'll have to write something a little closer to the money, maybe not at the money, but slightly out of the money. And then since volatility is so low, it'll be very inexpensive to buy, say, a call a little further out of the money. And the
Right.
idea with that is bring in the income, be able to have the distribution. But if the market does move higher, there might be a small period during that call spread where you're not gaining any movement, but we want to be able to capture the upside if the market does move higher within that month. So it has that mechanism where it can move back and forth. And that's why maybe if you read it in the prospectus or some of our materials, you'll see that in there. So a lot of people ask, are we always in a call spread? Or are we always in these laddered cover calls? It can move back and forth depending on
Okay.
certain rules in the strategy, really based around volatility.
Sounds like a super active approach that's really being managed month to month, depending on what the market does, what the volatility does. So you talked about coverage. You say it's typically between 75% and 90%, which is fairly significant, but that's only one portion of the strategy, the coverage. It's the moneyness, which you've talked about. So, what would you say is your average moneyness of your call options? Obviously, they're going to be out of the money because you're like your website says, we're trying to capture some of the upside of
Mhm.
the index. So what would you say is, and you talked about laddered options, and correct me if I'm wrong, I'm not a super expert here with options. When you refer to laddered options, it means multiple options at different strike prices, I believe.
Correct.
Correct me if I'm wrong there. So
Yes.
let me know about a little bit about the moneyness of these options here.
Sure. So when we are getting to the end of the month, when we
Mhm.
normally roll our option positions, we're looking to, if we're in that laddered short call portfolio, we're going to be selling those calls, depending on where the model tells us, at certain levels out of the money. And historically, since we'll use SPYI as the example, since it's been out the longest, over the past 2 years since inception, that range is anywhere from 1.5 to call it 4% out of the money on those calls.
Okay.
So you're looking at selling, and depending on where volatility is, again, just like you were saying, there's a certain notional coverage on those calls, which has been historically anywhere between 75 and 90%. So not only are you getting that move on the upside with, say, if your average, say, I don't know, 2.5% to 3% out of the money on those combination of short calls,
Yeah.
you're getting that move higher there if the market's moving higher, but also on the portion of the portfolio that's not even covered by
That's
those
not
short
covered.
calls can continue to move higher.
Okay. Okay. So in terms of coverage, in summary, in terms of coverage, it's approximately on average between 75% and 90, but the options are typically out of the, or are they always out of the money? 1 to 4% out of the money, would you
They're
say?
always out of the money when we're
Oh,
rolling
okay.
them. Of course, the market can rally and they could be in the money or some other place during that time frame. But when we're rolling them, they're going to be out of the money.
Okay, so yeah, you're capturing quite a bit of upside on one, the fact that the options are out of the money, but two, that there's a portion of the portfolio that's not even covered, whether it's 25%, 15%, or 10%. So
Exactly.
I think that gives investors a pretty good idea of how much upside they're giving up and how much versus how much premium. I think it's in the middle. I like to say that you guys are more in the middle where you're capturing some of the upside, but you are getting nice premiums as well. So yeah, I mean, I could see why the distributions are nice and high and consistent, but you're still capturing some of that upside. So Another
Yeah,
trend that's
and
been
you'll
going
see.
on. Sorry, go ahead.
I was just going to say, you'll see in the Nasdaq or the Russell, those have higher levels of volatility.
Yes.
So we might be writing a little further out of the money,
Okay,
and
good
again, we might
point.
be writing on less of the notional in those. So while they're using the same rules-based strategy, the volatility levels are different given the underlying indexes.
So probably capture a little bit more upside on those than the S&P, than the SPYI, and you could actually see the yields are a little bit higher. So on the Nasdaq and
Yes.
the Russell, they're in the 14s, whereas the S&P is more in the 12. So yeah, that's a good
Yep.
point. Uh, so you've been looking at what's going on in the market in all these ETF launches. A super popular trend is the zero DT options ETF. So index options that expire within a day or in one day. There's actually three providers offering
Mhm.
these types of ETFs. Is this a strategy that you guys have considered? If you can you integrate this strategy in your current monthly ones, or you're not planning on doing that and maybe launching new products? First of all, what do you think of this zero DTE trend that's been happening now in terms of options?
So I think for our products that are currently out there, we wouldn't change the strategy
Okay.
with what we're doing. We really like the way the strategy works. We've spent a lot of time researching and developing these option strategies to work with these underlying indexes. So we're not looking to change anything there. Of course, we've seen the growth in the zero DTE space, and it's something that we watch. We have no plans on launching anything in that space right now. I think it's good, like we were saying, how many funds, over 400 funds in this space now that are using options or trying to distribute monthly income. I think it's really important as clients start to look at what they're doing, they have to make sure that they're getting what they're hoping they're getting for. And what I mean by that is if you're looking at, and I'm not pointing out the zero DTE, but any option-based ETF, you should really look at it and say, can this total return of the product support whatever distribution it's putting out? And that's something where I would start if I was looking to invest in the space. If I want something that, say, pays a monthly distribution, great, the distribution seems right, but can the total return support it? What does the tax efficiency look like it on the end? Something we focus a lot on is the tax efficiency portion for at least the clients in the States, because we
Yeah.
try to use index options wherever we can. Those are classified as 1256 contracts, which gets that split from the IRS. It's 60% long-term cap gains, 40% short-term cap gains. So it's a little different than whether you're using an ETF option, an equity-linked note, some sort of swap, which is all more getting ordinary income on these trades. So it's something that we try to look at, while we have these high income, SPYI 12%, QQQI, call
Mhm.
it 14%, distribution products, we want to make sure the net after tax distribution is close to the gross distribution as possible. Because at the end of the year, when the client has to pay those taxes and they look at their 1099, they want to make sure that they're not paying, ordinary income or something like that on all of the income they received. So it's
Yeah,
something we
this,
really focus on in our space. But again, going back to the zero DTE, it's something we look at. We've seen the growth in it. It's been tremendous for those, as you said, those three different players that are in the space. But for us, we're really focusing on looking at the asset allocation pie. And as we said, we started off with the equity portion being SPYI, the broadest that we could do.
yeah.
And then we're kind of bringing it down to NASDAQ 100, Russell 2000, and so forth. And then on the fixed income side, we do have the other two funds, BNDI, which is our aggregate core bond fund plus some option income,
Yeah.
and CSHI, which is our T-bill fund plus option income. So we're really trying to continue to slice up that pie and basically fit into anyone's asset allocation.
Yeah, you talked about taxes, tax efficiency. It's not personally, it's not my favorite topic.
Yeah.
I'm not an expert in that, but I do have to commend you because on your website, you have a nice little film, a nice little video that explains ROC, the very
Hmm.
dreaded and misunderstood tax classification,
Yes.
and all the tax breakdowns for every single distributions are on your website. A lot of I've noticed, correct me if I'm wrong here, 90% plus are mostly classified as ROC, return of capital, which is super super tax efficient but misunderstood as well. People think it's their own money coming back to them, but it's really not. And I'll defer my audience if they have questions on that. Go on your website. You have a nice video explaining it. I've done it a million times on my channel as well. It's still misunderstood, but I think as more and more time goes on, people are realizing, okay, this is not just my own money back. Obviously, this is has to do with tax classifications, accounting, and that's it. So I encourage
Yeah.
people if they have questions on that to do that research on your website, which is great. So um, moving on. So my community, myself included personally, we're really buy and hold long-term investors, right? We're just buying these, just like a growth investor would buy the SPY or IVV or VOO and just hold it forever. We buy these, we live off the monthly income. If we don't need it, we reinvest it, maybe spend half of it, whatever. It's really about that income. So in Canada, I don't know if you know this, but in Canada, there's very popular, there's leveraged versions of these, right? So there's S&P 500 with covered calls, Nasdaq 100 with covered calls, everything that you guys have, but there's leverage versions. So what they do is they borrow only 25% leverage, so they 1.25x, they borrow 25% of the assets, and that increases the yield a couple of percent and increases the return profile over the long term, increases the volatility a bit as well. But because we're buying and holding, I don't really care about the month to month volatility. So is this something you guys have considered, launching leverage versions? I know Direction is launching leverage versions of JEPI and JEPQ. They filed their prospectuses for those. They haven't come out yet. Are you guys thinking of it? My opinion, that's the next step for these types of ETFs on the US market.
It's definitely something we're looking at. Can't comment since we don't have a filing out there, but it's
Huh?
definitely something we're looking at. And we have seen, that there is a portion of someone's asset allocation model where a leverage product might make sense. And so we again want to keep dividing up that pie and make sure we have everything covered. So as we grow, as NEOS grows as a firm, we will definitely be looking in that area.
Fantastic. I'm very optimistic. I'm very optimistic. Have you guys considered an all-in-one type solution? Now you got the three indexes. You even got one that focuses more on T-bills, aggregate bonds. We're getting, more multi-asset class, multi-index, small cap, Nasdaq, S&P 500. Are you guys considering? I know you can't talk about future products, but kind of an all-in-one solution where, let's just say, you combine the three indexes. You have a big U.S. equity style with all three indexes. Have you guys thought about that as well?
It's something we've looked at. The feedback we've also received is a lot of people would like to just own all three in a sense, if you're just looking
Yeah.
at equity side. So they'd like to own SPYI, QQQI, and IWMI in their own portions, in their own percentages that they would like to own them in. So if we put one together, that's going to be, a static, different percentage for each one. I think they prefer to kind of toggle between them, as maybe potentially the end of this year rates are going to be coming in. Would they want to be more in small cap and kind of overweight that one versus the others? So that's kind of the feedback we got. So we're not looking at that right now. We've definitely talked about it though.
Okay. Yeah. Okay. Cool. What about international stocks, like stocks outside of North America, for example? I notice there's not many covered call ETFs that cover either those stocks or those indexes. Do you know why?
Mhm.
Obviously you have the three major ones or three of the major indexes in the US. Are you looking at international stocks as well? Or, well, from what I've heard, the options market are not big there, if not non-existent. What do you think about that?
There's definitely an options market for it. I think it's growing, but I think for now we're focusing on the US. We will get there, I think, eventually, but we want to make sure the space is growing enough for the demand to kind of come into it. That's how we're viewing it right now.
Okay, fair enough. So last couple of questions here. Income investors in the US obviously now have a lot of choice. You guys have a lot of competition. Why should income investors that really want an index-based cover call product with monthly income choose NEOS over your competition?
That's a great question. A lot of people say, why NEOS? You guys are new in the space. And yes, the firm is new and our products are a few years old, with SPYI being the oldest at 2 years old. But for us, we've been doing this a long time. I've been in the business over 25 years, managing different portfolios, different option strategies for institutions. And we were also some of the early pioneers, as I said earlier, in the option-based ETF space over a decade ago. So
Hmm.
we've been in this space for a while, so it's nothing new to us. Something I always say when people are looking at option-based ETFs, or when they're looking at different managers, and maybe particularly looking at NEOS, this is all we focus on. We're not a thematic player that has a side business of running option strategies because it might be a hot space right now. This is what we focus on. So for us, we looked at it as we had spent, my co-founding partners and I had spent a lot of time on the institutional side of the business, running these type of strategies for large pensions, endowments, and we said, wouldn't it be great to just bring it back to the masses, be able to put it in an ETF structure where anybody could buy one share if they want and have
Yeah.
access to this kind of management, this kind of tax efficient income, and really have a real nice institutional quality portfolio in an ETF wrapper that That was kind of where this was born out of, and we wanted to really come back to owning our own business and building that from there. So all we focus on is option-based ETFs. One of the other things we pride ourselves on is being available. Like you said, we have some great resources on our website at neosfunds.com, but we also, you could always put in a question there, and we get back to people, whether it's one of our sales representatives, or if it's an advisor that wants to talk to us as portfolio managers and dive into the strategy because they want to make a larger allocation. We really pride ourselves on being available to our clients.
Yeah, yeah, fair enough. Yeah, for sure. I mean, I get that concern a lot from more newer investors. They say "Hey, this fund is new, this ETF provider is new, but if you really think about it, the S&P 500 is not really that new. The Nasdaq 100 is not new. It's just there's a little twist on the assets are not new. It's just the option strategy. So as long as you understand that, you're fine. I don't have any concern, because the ETF's only been around for a year or two. And like you said, Matt, yes, the firm might be new, but if you actually look in the bio on the website, you'll typically see like 20, 25 years, used to work here. So it's good. Hopefully that reassures,
Mhm.
potential investors, especially more inexperienced investors that are more used to like, the BlackRocks and the Vanguards, which don't really have many of these types of things, or more into the index space, classic stuff. So in terms of macro news, look, interest rate cuts almost certain starting at September. Maybe will continue throughout 2025. How do you think this rate cuts will affect your ETFs? Do you think they'll be well suited for these changes? Typically, we know rate cuts just helps everything go up. So, how are you seeing these rate cuts, the impact
I,
for you guys?
no, it's a great question. I think people are always searching for income, just like you find with your community.
Yeah,
People are always looking for income, and as rates come in, and will probably see more interest in this space, more people looking to supplement that income that they lost from that CD or the money market they're in, as those rates start to come in. So particularly if you look at something like a CSHI or BNDI in the fixed income side, those are adding additional income through the option strategies over whatever, say CSHI, over whatever your T-bills are doing. So as T-bills come in from 5 to maybe 4% this year or lower next year,
yeah,
adding that extra income on top of that will supplement that and make a big difference. So I could see those products really growing. And along with our equity products, we've seen consistent inflows, which have been great. But I think as rates come in, people will still be searching for that income. And I really, in particular, we talked about earlier, but IWMI, our newest product, which has
the
grown
Russell
nicely, the Russell 2000.
1000. Yeah.
But you're going to see that small cap space as rates come in. It really helps those smaller companies that really use financing to grow their businesses. So you might see, kind of a move up in the Russell 2000 in the small cap space potentially as rates come in. And if we could still provide that added income from the option portfolio, it could be a really great place to be.
Yeah, fair enough. I know we didn't talk much about the fixed income ETFs or cash alternatives. So you do have BNDI. That's, I believe, the aggregate bond ETF with some options for additional income. When I hear aggregate bond, I kind of think of like the whole bond market. Kind of, it's more diversified within the fixed income.
Mhm.
So obviously, rate cuts would help that one. And I believe that's a product really designed for what kind of investors would you say? Just someone who wants some stability, some more fixed income exposure in their portfolio, maybe to complement the equities, but still to have that a good sustainable level of monthly income. Would you say that's correct?
Yeah, when you think about it, there's always going to be a group of investors that want to have a portion of their portfolio in some sort of fixed income, and maybe in some sort of equities. And it changes over your investing lifespan as you get
That's true.
older,
Yes.
and maybe you need more consistent, but you don't want to take too much equity risk because you have a fixed, set of expenses as you grow older. And so it's something that we wanted to make sure we had out there. And what BNDI does is takes we use SPX index put spread. So a little different than the call side of the chain. We're using the put side of the chain to bring in additional income over whatever your core aggregate bond portfolio is doing. So if that's yielding right now, call 3.5, this is designed to give you an extra 2 to 2.5% over whatever that core aggregate bond portfolio is doing.
Hmm.
So you get to that 5.5 to 6% right now, where it's yielding. And if you look at it, what we wanted to do is not so much when we're looking at the fixed income side, we're not targeting an income, we're targeting a risk profile. So we didn't want to increase the volatility, increase the risk you're taking in the overall portfolio by adding options. So we pair that with the aggregate bond portfolio, and you can see the standard deviation kind of stays the same across whether you had the options or you have the options, but you're adding that additional, call it 2 to 2.5% on average over whatever core bond is doing, which is added income to an investor on a monthly basis.
Yeah, that could be a very interesting option. Someone wants a bit lower volatility, complement the equity, wants a bit of fixed income in there. And you guys also have CSHI, which I feel is more even less risk than the aggregate bond one.
Yes.
That's more like a cash alternative. It's really short T-bills. With the same thing. Is it the SPX put
Very
spreads as
similar.
well?
Yep. Very
Okay.
similar put spread strategy, but it's a little further out of the money. And both these products, whereas you think about the equity products, we're rolling those monthly. These we roll weekly. We want to make sure we're rolling
Interesting.
them, collecting premium off of those short put spreads, but we want to stay away from where SPX spot is. So we don't want to get too close to where the market is, and we want to keep that volatility low for both of those portfolios. So very similar strategies. But CSHI, again, lower volatility, a little
Well,
further out of the money because it is your ultra short duration portfolio. It's where
yeah.
people might park some cash for some time as they're maybe thinking about doing something else, but you're going to get, an added, call it 1 to 1.5% historically over whatever that 1 to 3 month T-bill is looking like for you.
Yeah, so I think last I checked, it's something, 5%, something like that, which is pretty good for cash, for cash sitting there, cash alternative, especially when rates going down because your classic CDs, those rates are going to go down as well. So looks like you guys have, nice five products for different investors, different risk profiles. So it's really, really cool. So Troy, that you've been with us for a long time. I really appreciate your time. I know you're a busy guy. I really appreciate it. We'll be keep following NEOS, and we'll look forward to more products. And I strongly encourage my yarns. Check out your website. You got good information there. A lot of great products if you really want that consistent monthly income. That's what stands out to me, especially with those equity ones. And looking forward to having you back again. Thanks so much.
Thank you.